Hi, whenever the PowerPoint is getting set up, I'll just do a very quick introduction. We're going to do the first block now, which is the global overview on payments. It's going to be for an hour and 15 minutes. There's going to be 4 excellent speakers, and then we're going to have 20 minutes of Q&A at the end. So please do scribble down your questions as you hear us go through the presentations. And this only leaves me to invite Jason Lamb to come up and speak. He's Deputy Director of the Financial Services for the Poor team and at the Bill and Melinda Gates Foundation, and he's going to be presenting on the role of digital financial services in enhancing financial inclusion. Jason, welcome to the podium.
Thank you, David. Thank you, Ellie and Leon, for the nice introduction and the recognition to the support from the Bill and Melinda Gates Foundation for the DFS Observatory here at the Columbia University. It's a real privilege to be asked to speak to this in this setting. I mean, there are many people here with so much broad experience. And it's a real pleasure for me to have the opportunity to speak and open up the 2-day session. I'm particularly excited because the world of fintech, payments, and financial innovation is really turning to tackle some of the problems that affect the poor and providing them access to financial services. And we're very excited at the Gates Foundation that this community is now interested and really bringing their thinking, the new technology, and innovations to this sector. Okay. How do I go forward? Oh, here? Yeah. That's right. There we go. Okay, all right. So in my short time today, I wanted to focus on 3 things. So first of all, just the role of digital financial services in financial inclusion. And in this session, I really want to focus on the digital part because I think that's one of the most important components. The second is really around digital financial services and its impact on economic development. And I'll share some research that we've done with McKinsey Global Institute to show what the impact on GDP is. And then third, we've created a new framework that we'd like to test today. And we'd like to hear feedback and your thoughts on where the frontiers of digital financial services are going. So first of all, the latest Findex data that we have done in 2014 show that 2 billion people are still excluded from the formal financial sector. This was an improvement over the 2011 data, which showed 2.5 billion people, and in fact, it was a net gain of about 700 million people. Of those excluded, about half are above and half are below the poverty line. Research shows that poverty isn't really static. In fact, we find that 10 to 30% of people fall back into poverty, fall under that poverty line in a given year, and 10 to 40% climb out of poverty in a given year. So you kind of have this the cycle of falling in and coming out of poverty. And that can be driven by lots of things. The falling down into poverty could happen because of a health issue, it could be poor weather that leads to bad harvest, or an expensive funeral that drain resources that those families have saved for their future. On the upside, good harvest, investment in a business that actually does well, or an educated child that gets a salaried position can actually provide excess resources for those families so that they can climb out of poverty. Financial services have or lack thereof can either magnify or mitigate the risk of these sort of good and bad things. Indeed, access to safe savings, credit, insurance, and even payments can have a positive effect. So traditional banks and MFIs, I think that we all understand this, have a cost structure that doesn't really allow them to profitably serve the poor. And in fact, the line of which they can serve profitably is way up there at the top. Therefore, those customers are forced to use expensive products, sometimes 30% or more per month in interest, or informal products that cause them to really not be able to get ahead. This is where digital financial services comes in. It actually drops that profitability service line down to almost include everybody. I mean, I can't say that it includes everybody, but if you have an enabling regulatory environment, consumers can access their accounts digitally, and the cost to serve drops by about 90%. Digital delivery also opens up opportunities to offer different products and services so that companies can make different revenue streams from those same customers. And this allows providers a chance to serve many more excluded customers profitably. This is not easy to do. And in fact, we'll hear a lot of examples over the next couple of days of different companies and organizations that are finding new ways to reach, to serve the poor profitably with products and services. So the second area that I wanted to talk about is how digital financial services can impact economic development. So expanding digital financial inclusion to the excluded not only benefits those customers that actually have access to an account, but it also impacts governments and the private sector. In 2016, McKinsey Global Institute, with support from the Gates Foundation, completed a research project called Digital Finance for All, Powering Inclusive Growth in Emerging Economies. And I'm happy to send the link to that if you're interested. But the objective was to quantify the impact of expanding DFS to 95% of the world's population. And we did a lot of modeling and tried to keep our estimates as conservative as possible. And the results are pretty striking. For governments, we found that it would add 3.7 trillion or 6% in GDP by 2025 if digital financial services were expanded to 95% of the world's population. They would also save 110 billion annually in G2P or P2G leakage. For individuals, of course, there would be the 1.6 billion newly included individuals and about 95 million new jobs. And then finally, for the private sector, and really focusing narrowly on the financial sector, we saw that this would create $2.1 trillion in new credit and $4.2 trillion in new deposits. So if we go back to the 110 billion annual reduction in government leakage, we actually did a double click on that with a paper that was presented at the IMF conference, Digital Revolutions in Public Finance, in April this year. And we did a lot more robust analysis just specifically on that column. And we found that actually that estimate to be about $220 to $320 billion annually in G2P and P2G leakage savings by digitization. So this is, a lot of positive benefit. And we think that this will get the attention of policymakers and even the highest levels of government to address the issues needed to have a full digital infrastructure in their countries. Secondly, digital financial services is also a key enabler of 11 of 17 of the UN Sustainable Development Goals. And you may ask, why does that matter to this group? But we found that with the MDGs, which were completed in 2015, that determined how public sector financing went towards investment in the developing world. And so now that we have the Sustainable Development Goals established for the next 15 years through 2030, the fact that digital financial services has an impact on 11 of them should mean that, that governments will prioritize this important investment sector. And in fact, the more our community and those people in this room and those people that are a part of the broader community advocate for the importance of DFS in achieving these goals, the more it will be prioritized by ministers. I'll give you just one example. If you look down here at the bottom where it says pay-as-you-go payment technologies, this is one very specific technology that was enabled by mobile payments, mobile technology, and GPS systems to make clean water and clean power, like solar, available to consumers who cannot pay on a monthly basis but can pay on a daily basis. And so it's helping achieve that number 6 goal, the clean water and sanitation, and also helping with power. So finally, I'd like to share with you this framework that we put together to explain where we see the frontiers of digital financial services spreading out. If you look at this, first on the vertical axis, we have basic payments going from what we've seen as traditional mobile money to advanced value added services. And I think we've been focusing a lot more on this aspect. We thought once we get mobile money or some other digital payment mechanism, we'd see just more digital financial services happen. But we've seen more recently that the horizontal axis is creating new and sometimes more catalytic market forces, from a competitive market-led model to one that's more collaborative and government-enabled. So what does this mean? As you expand up, you see things like digital credit, robo-advisors, and so forth that are just more digital partnerships delivering products and services digitally using payments essentially as the mechanism. And in fact, we'll hear from other speakers about some of these things later in the day. As we expand out, you see a lot of work around greater linkages of digital payments with ID, RegTech, digital fiat currencies, and the like. So this requires both enabling regulation, collaboration of public and private sector, and in some cases, full government participation. Let's see just a couple of examples. A really familiar one, everyone here will probably be very familiar with Kenya. It started with M-Pesa and grew into offering M-Shwari, which is credit and savings, Kopo Kopo, which does merchant services, M-Kopa does solar, and then M-Akiba, which is now offering government bonds to micro purchases. So it's just an expansion of that. A good example of what we've seen going out towards the right is in India. The PMJDY effort begun by Prime Minister Modi added over 200 million new accounts to the India financial sector. And they combined that with the JAM Trinity, so the JDY of the PMJDY, the Aadhaar ID system and mobile, and other infrastructure such as the Universal Payments Interface. So India as a government has been a driving force in digital financial services expansion and competition. And soon they will start expanding up. So where they're combining the UID with digital consent, DigiLocker, and the India Payment Stack and India ID Stack. So they might be headed back over, whoops, I clicked the wrong way, headed back over to the left, where Paytm is one of the new payments banks that's been launched recently, and we don't know exactly how that's going to impact the market, but we see that the catalytic effect of the government having a role in this, and a very sort of enabling role, is really changing the market in India And in fact, it's creating, I would say, a broader set of products and services for consumers. So lots of exciting stuff happening. There's plenty of other examples. I include here Jomo Pay in Jordan and BIM in Peru. And then we've got even the PSD2 in the European Community, are all efforts for government to play a role in making financial services, ID, and more robust solutions for customers. So finally, before I'm running out of time here in, I guess, 30 seconds, I wanted to bring us back to the end consumer. And some research that was done that the Gates Foundation supported by Billy Jack of Georgetown and Tavneet Suri of MIT that they published last December in Science Magazine. And they did research in Kenya that showed that over 200,000 Kenyans were lifted out of poverty simply by using M-Pesa. And how did this happen? First of all, it increased their resiliency and their connection to the social network beyond the community in which they lived. So when a shock happened, their consumption didn't drop, and they were able to access funds that they needed when they needed it. Second, they had greater access to economic opportunity by that increased social community. They found that they shifted their income and occupation from subsistence farming to small businesses, to retail, and it gave especially women-led households a new freedom to earn and contribute to their household income. And they also increased their savings. So in short, it had actually real impact on the lives of individuals, families, and the communities. And that's just with payments. So over the next couple of days, we're going to talk about a lot more than just payments. And so I think that we're going to be able to see a lot more amazing impact. And so I just hope that as the folks in this room continue to discuss, we have good discussions, we're going to hear about lots of great technology, a lot of great presentations, a lot of wonderful products, but let's keep in the forefront of our mind that end consumer and how this can actually transform their lives. So thank you. I think we're going to take questions at the end. Yeah.
Please do.
One of these slides that you presented.
Okay.
Please do write in your question, and we can take them at the end.
Okay.
Yep.
Lots of seats on the other side.
Thank you, Jason, for an excellent presentation. Next up, we have the Managing Director of Consult Hyperion USA, Howard Hall, and he's going to present on the state of mobile payments globally. Thank you, Howard.
There we go. Completely forgot to give Jason the slide advancer. Sorry about that. Okay. So you get the benefit of that. And keep going forward and back. Perfect. And if you need a laser, I should need a laser, just in case. Thanks very much. Good morning, everyone. Thank you for being here today. This is, and I think Leon knows, this is literally one of my favorite events of the year. I think this is the third or fourth year I've presented here. And it's really a pleasure and a privilege and an honor, so I'm humbled to be here, and I thank Ellie and Leon for inviting me back yet again. So hopefully maybe next year I'll be invited as well. So we're going to talk about the state of mobile payments globally today, and I think the logical place to start there is just start with some basic numbers to sort of ground the discussion. You have a population of about 7.5 billion people. You have mobile subscriptions now flirting with 7.3 billion subscriptions spread across 5 billion mobile subscribers. So the penetration and growth globally has been, nothing short of extraordinary in the last few years. We're celebrating the 10th anniversary of the iPhone, if you can believe that. It seems amazing how much has changed in 10 short years, where it's sort of become the epicenter of many of our lives for everything from I mean, frankly, for me, a phone still primarily serves as a function of communication in terms of making calls and texting, but it's really integrated itself into our lives, maybe no other technology in my lifetime. I think the interesting thing about this as well is you look at the proliferation of technology in the mobile device, 9 out of 10 new phone purchases on a global level are smartphones. So the age of the feature phone is quickly coming to an end. And the ability to deliver the types of services and solutions we're going to talk about over the next couple of days at global scale is incredibly encouraging. I think the other thing that's really interesting is 10 years ago when the iPhone was introduced, and this spans all phones, both smartphones and feature phones, the average age of the mobile phone user on a global basis was about 25 years old. It's now on a global basis closer to 15 years old. So that technology is integrating itself into our lives at a much younger age. And for any of you that have young children at home, you probably already know that. If you look at some sort of simple facts and figures in sort of the bottom part of the chart here, I don't think there's any surprises. There's no epiphanies you're going to see here in terms of where the preponderance of the adoption is. It's in developed markets. However, what I do find incredibly encouraging is you see places like Africa, India, and even Latin America, where, along with Leon and myself, we spent a fair bit of time over the last couple of years with astonishing penetration of this type of technology. And while it's very well embedded in the developed world, as you might imagine, the growth and the trajectory under which it's gaining traction in the underdeveloped world, the emerging world, is simply amazing. So if you sort of start with that baseline in terms of just the ubiquity of mobility and devices, and now we sort of delve into the subject matter that we're going to talk about a little bit this morning, the concept of payments, it's equally as astonishing and equally as exciting. There were just about $620 billion in mobile payments transacted in calendar year 2016 across about 400 million mobile users. By and large, the primary function still is the ability to move money amongst people, the ability to send money to a colleague or a peer or a family member still largely dominates most of the transactions taking place in the mobile money arena, representing about 71% of the transactions. However, again, where this becomes incredibly encouraging, and I think Jason touched upon this, where you're really seeing to start a lot of growth is in merchandise payments, being able to engage in commerce with your local vendor through the ability to exchange value between two handsets or between a handset and a POS system. Bill payments are still sort of coming online. Certainly in the emerging world, there's more of them, and NFC payments have been sort of static for the last few years. But again, if you look at the two charts below, that's indicative of the type of growth you've seen. To imagine that 5 short years ago, this market has almost quadrupled. It was a sizable market then. So you don't classically see those types of growth trajectories in a $100 billion market where it quadruples in 4 or 5 short years. So this hockey stick type growth, I believe, will continue. I believe this amazing amount of evidence to support that statement. And I think that's what makes all of us pretty excited to be at events like this and to work in the world in which we do, because of the type of opportunity that can be brought to bear to change our lives, but to change the lives of people all over the world. Gartner says it's going to be 35% year-over-year growth, and that we're going to be at the dawn of 450 mobile users this year. So again, engaged in payments. So that's a pretty impressive statistic. Now, if you remember back to the prior slide and the earlier slide, we talked about where the majority of the users were and where the majority of the devices were and the majority of the connectivity was in the developed world. But this slide flips that equation upside down. So we've had the benefit in the developed world of something known as infrastructure. We've had the ability to have connectivity in a variety of different ways through a variety of different channels for on or about 20 years now. So when you look to the emerging world, places like Sub-Saharan Africa, places like Latin America, certain areas within Southeast Asia, they've not had that infrastructure. So the innovation, the creativity, the necessity of finding alternate channels under which to conduct commerce, to move money, to make payments, really has leapfrogged them well in front of us in the developed world in their ability to engage in this type of commerce and these types of transactions. So Kenya, it was mentioned earlier, and the astonishing and just amazing lives that would change there through the introduction of M-Pesa and the advancements and the innovation that's continued to go on with M-Pesa. Uganda, places in, again, sub-Saharan Africa have multiple peer-to-peer money solutions, all of which are gaining steady growth and changing lives of people every day. You're starting to see a variety of different channels under which these payments can be made. There's the digital channel, there's the messaging channel, and we're going to talk a little bit in a few minutes about the WeChat payment solution and sort of the way that's integrated itself as one of the primary ways people pay for things in places like China. Through the innovation, through the mobile channel, you can deliver security, you can deliver frictionless commerce, you can deliver an experiential, experience in what's a pretty mundane, pretty boring way to go. So we're starting to see a lot of growth. I think there's a variety of people, the card schemes, the merchants, the innovators, the foundations that all recognize this. If you were to just take a few simple examples of people that are gaining traction in this space, PayPal's been around for a long time. They've changed their business model. They're still growing year over year, primarily with an API-based strategy into the merchant community. Alipay, amazing, is at last reported doing the double volume of transactions of PayPal. And WeChat has 697 active users in the messaging channel, where they've taken a very, very small transaction fee, created a very experiential, real-time transaction, and it's just grown at astonishing rates. So what are the drivers of success? Well, again, you have this ability to have a device on you almost all the time. You have a channel that can be secure, that can deliver an experience, that can provide a variety of different services and solutions through that channel. And so you're starting to see costs coming down to both merchants and consumers. I mean, astonishingly down from where they were a few years ago. You're starting to see broader acceptance, both here and in the developing markets. Again, I think it all comes down to the experiential component of when something's going on that makes it exciting. And then there's a massive amount of data that's being exchanged. And through the exchange of that data, you can create incentives, rewards, security, loyalty, and identity. Despite all the obstacles, I'm going to move through these quickly, you're still seeing great growth. There's still largely a poor understanding by consumers. People that get to my age still use a lot of texting and talking as the primary function of their phones. Merchants are still trying to figure out how they're going to absorb these costs. NFCs struggle to gain acceptance, particularly here and in Europe. There's still regulatory and compliance issues. There will always be. And there's still some uncertainty around who owns the transaction, in particular the data associated with transaction. But again, despite all these barriers, we're in a truly exciting time, and the adoption and the growth, I think, speaks to that. So who's going to win? Well, there's going to be a variety of winners. I don't think there's going to be any one winner. My favorite transaction is getting in an Uber, telling them where I want to go, and getting out, and there's the payment invisibly in the background. I used a Starbucks card this morning on my phone to buy a coffee. I tapped into the subway recently with my phone using Apple Pay. I think we're going to start seeing a lot of growth and adoption in the messaging channel, and of course the peer-to-peer guys, whether it's PayPal or M-Pesa or Ping It in the UK, have really sort of gotten a lot of growth and adoption and doing some really interesting stuff. So I don't think there's going to be a winner. I think there's going to be a variety of services to serve a variety of different needs, and we're in an age where we're going to carry a variety of those different solutions in our back pocket, which is really, really exciting. So I bumped her up right against my 15 minutes, I think. I think it's the first time I've ever come in under. So with that, I'll turn it back over to David to introduce the next speaker.
Thank you. That was really interesting. Next up, we have Sean Rodriguez, who is the Senior Vice President at the Chicago Fed, and he is also the strategy leader of Faster Payments. Welcome.
Forward, back. Laser if you need it. Forward, back. I think I got it. Thanks for having me here this morning. Appreciate the comments of Jason and Douglas. I hope to dovetail on those. In fact, with the kind of the world view and some of this view about the digital commerce that's starting to emerge. All of these trends, the Federal Reserve has been paying attention to for a lot of years now. And I want to describe to you kind of the process we've been going through to help energize the discussion here in the United States about how we can be better about payments innovation and perhaps getting ahead or catching up in many ways to what's happening around the world and helping to enable our economy to take advantage of all the capabilities that Jason talked about in terms of the potential benefits that are available, as well as the governmental approach that can help catalyze some of the activity. That's kind of where we see our role, our actually wheelhouse, the Federal Reserve and the U.S. economy, and I'll try to describe that a little bit in my remarks. So I wanted to start out with, we all know this story, and I think this underpins some of what we heard from Jason and Douglas. The United States is a very messy marketplace. Lots of providers, whether it's technology or financial institutions. No other country in the world has 12,000 financial institutions with deposit accounts and transaction accounts, as well as all the new fintechers, the last 8 to 10 years of evolution there. We're a very complex marketplace, an $18 trillion economy that actually, when you think about it, moves money around pretty effectively today with all that we have on our plate. Now, could it be more effective? Yes. And a number of years ago, we started to look at this issue and say, you know, from a Federal Reserve perspective in the payments world, that's one of 3 responsibilities the central bank has. We do monetary policy, which you all know about. The other is supervision and regulation of banks and systemically important payment operations, as well as payment services for financial institutions. So in that third area, payment services, we started to ask the question of the industry in the United States, what should we do next to improve our payment system? So back in 2013, we did a consultation paper. We had a whole discussion with the industry, with forums and this feedback mechanism. And in 2015, after all of that work, issued what we called a Strategies for Improving the U.S. Payment System paper in January of 15, and really focused on these 5 areas of improvement, and we call them desired outcomes. None of these are going to happen overnight. This will be an ongoing focus, of course, for the Federal Reserve as well as the payment industry as a whole. But they were around speed, and that's what I'm going to go vertical on with you guys today, the speed, desired outcome, security, of course, in the payment space, efficiency, international cross-border capabilities, and achieving all of this in our world here in the U.S. With this thing called collaboration. Because in our country, unlike many other countries where there's a lot of an opportunity to mandate things from the central bank or the legislative authority, none of us in the payment industry ecosystem believe that the best place to start in the United States with the U.S. Congress for any kind of action. So we're going to try it a different way. We're going to do collaboration. So that was kind of the essence of that strategies paper. So I want to talk to you a bit about the Faster Payments initiative that we've undertaken. And it's been my responsibility over the last couple of years since we issued that paper to pitch a big tent and not just talk to financial institutions or fintech or big tech companies, but to ask any and all people that are interested in this payment system improvement initiative to join us on a task force effort to look at what it's going to take to achieve the desired outcome we laid out in that paper for a safe, ubiquitous, faster payment capabilities for our country. So believe it or not, we had 320 people raise their hand and say, I'll do that. And I think we have a number of task force members in this room, as a matter of fact. Raise your hands who are participating. Good. I know we recognize a couple. So we undertook this effort then to say, let's take a look at this. Let's come up with a process. We spent 2 years now. We're about ready to culminate our work with a paper we're going to issue next month. We just finished voting on the paper yesterday. Really excited about the results there. I think you'll all enjoy reading that when it comes out next month. Our target date for release is July 25th. We might beat that by a day or two, but more to come on that. So the task force got busy with, let's take a look at what we as stakeholders, we had consumer advocacy groups, we had merchants, corporates, we had financial institutions of all sizes, including credit unions, saving loans and thrifts. We had people from academia. We had a very diverse group of individuals show up for this work effort. We had the card networks there. Anybody and everybody that does payments did devote some time to this, which was outstanding. But in the first 7 months of the work that we culminated in the early 16 timeframe was to issue what we call a faster payments effectiveness criteria. Believe it or not, we got 320 people to agree on 125 points of emphasis in a new payment system that would deliver this faster capability for our country. And this is end to end. So it wasn't between financial institutions or fintechs and banks. It was from the originator of the payment all the way to the receiver of the payment. So with that criteria then, we published that in 2016, and then we said, you know, it would be interesting and handy if we could have some of the solution providers provide their sense of how they could perhaps meet that effectiveness criteria with a solution. And our objective here wasn't to pick a winner, as we talked about earlier. It was to raise the thinking, the awareness across the task force and eventually the industry about what's available, what kind of technology could be brought to bear here to actually achieve this faster, ubiquitous, safe new payments rail for the country through this process. So there's no way we're going to have 320 people assess a number of proposals. We actually had 22 proposers come forward and say, hey, I've got an idea how to do it end to end. We hired a McKinsey to help us do what we call the qualified independent assessment on behalf of the task force. The task force weighed in on those assessments and the proposals themselves. Did a lot of work to analyze all of what could be there, trying to raise the boat of each of those proposers to try to, in the end, help to incent and bring about faster payments capabilities for the country. So we've culminated that work now and have finished. You'll see 16 of those proposals in the ultimate report. We had off-ramps for proposers to make it safe for them if they didn't want to continue in the process and be very public with what they put forward. Started with 22, ended up with 16 that stayed for the whole process, and you'll see those in the report next month. So very excited about the ideas that were brought forward there for this new payments rail that would enable the mobile commerce we're talking about here at the conference, and are excited to share all of that with you when we publish the report next month. So the other point I wanted to raise about the where we're at with the task force work is beyond the publishing this get ready, because the report's going to be almost 3,500 pages long. That's most of that, just to warn you, is the proposers, and there's solutions and the assessments and all of that. But there's about 52-ish pages of the, here's the essence of what we did. And then most importantly, here are the recommendations for what we want to see happen beyond this task force work that's going to culminate in July, and a vision and goal that this task force is calling to action the industry in the United States to work through all the issues necessary to implement a faster payment solution. So was that 5 seconds or 5 minutes?
5 minutes.
5 minutes, okay. All right. So what happens once we publish this report? So our goal at the Federal Reserve is to continue to lead and catalyze this industry effort in a messy marketplace with lots of commercial interests at stake. You all appreciate what that means. We're at a point now in this process where that there are capabilities in the marketplace today. There are some coming to the market. For example, the Clearinghouse has announced the build that they're doing for a faster payment solution, which is 22 of the largest financial institutions in our country. A wonderful development that they've grabbed a hold of this and are going to try to move this forward. So our idea is to, of course, socialize these recommendations with the industry, get the call to action laid down for CEO and below in every organization that touches the payment system to get engaged with how can we make this new payments rail happen, how can we enable the kind of mobile commerce we're talking about. And then, of course, executing on the 10 recommendations you'll see. They really are going to be in 3 categories. One is kind of the governance and rules, regulations of how this new ecosystem is going to be governed and regulated. The second area of recommendations are around infrastructure. What do we need to build as a ecosystem to make this a reality? And then the third is in the area of sustaining and evolving this emerging ecosystem. So when you think about how ACH was put together many, many years ago, there were regional associations, and then they created this national association for governance and rules and all of that. So a lot of thinking needs to be done around those areas. So we're excited about the information and word we're going to share with everybody here in the next month. Couldn't be more appreciative of the collaboration that the task force assembled to accomplish. Incredible meetings, as you can imagine, with that diverse group of stakeholders sitting around the table coming to agreement on particular issues like overdrafts, if you can just use that as an example, with some of our consumer advocacy groups and some of our financial institutions. We had some mighty interesting discussions around some of that. So, but I'm very proud of the task force work, the fact that the industry stakeholders devoted all this time and energy to this for the good of what we think the payment system in our country that will lead to all of the benefits that Jason talked about earlier. So with that, I'll conclude.
Thank you very much, Sean. I'd like to invite Douglas Pierce up. Doug is the practice manager for financial infrastructure and access at the World Bank, and he's presenting today, Enabling Digital Financial Inclusion.
Good morning. Thank you to Leon for the kind invite. It's great to be here. Following those excellent presentations, I'll share some perspectives from the World Bank's view in the sense of our perspective of working with developing emerging market partners to extend and expand what it can be termed digital financial inclusion, but also perhaps with a more industry focus, you could term it inclusive finance. So digital financial inclusion, inclusive finance. I thought the graphic which Jason put up where he had how digital financial services can push down the barriers for people to enter the financial system was very useful. And that's primarily, that's one of our main entry points when it comes to working with countries to better harness the use of digital technologies for financial services. Some various aspects of this which we find particular priorities for our partners in emerging markets. Market entry. FinTech, as long as there's sufficient market entry, fair, balanced playing field, enables competition, and it also enables the kind of cooperation and specialization, including through APIs, which Jason and others have referred to. Some of the thorniest issues around financial inclusion historically have been around information asymmetry, risk mitigation, pricing, designing products for consumers that really there was no data on. So now there's a volume and a wealth of data coming through new alternative data sources. So the challenges are really around how to harness that data, how to make use of it. But those absolute barriers around information and risk mitigation and pricing and product design are increasingly being removed. And convenience. It's much more convenient to access digital financial services in many cases. Now, we work with regulators, so we also, and with standard setting bodies, so we also come at this from review around risks and challenges, around what are the issues around stability, financial integrity, consumer protection, as well as the opportunities. And if you look, the issues around regulatory and supervisory perimeter, and there's potential for arbitrage, regulatory arbitrage, when regulatory frameworks for fintech are confused or absent. And that brings with it depositor-investor risk. If you look at the case of China, with the phenomenal growth in P2P lending, crowdfunding, with that has come losses for depositors or investors. Over-indebtedness, look at East Africa, the phenomenal growth in mobile money. On top of that, you now have very quick access, 3, 4, 5-second access to digital credit based on your mobile phone usage and other factors. And funnily enough, with that come some significant challenges around over-indebtedness and linked with the credit information system, transparency, responsible practices. So fraud is an area, the more digital financial services are, the more digital the providers, the systems, the use of data, also the more vulnerable potentially to cyber attacks and to fraud. And we've seen that cryptocurrencies can be used for, obviously, for illicit activities. Now, all of these different areas potentially have impacts on the central circle there, which is financial stability, and also integrity and consumer protection. So a lot of our work with developing country, emerging market partners is around mitigating these challenges and addressing them while ensuring the opportunity is taken full advantage of. So last year, under China's leadership, China was the president of the G20. The PBOC and ourselves, we set up a task force and a committee to develop a set of principles for digital inclusion. We worked together with OECD, with the Alliance of Financial Inclusion, with the UN, with the Gates Foundation and others, and we consulted with industry. And this is what came out. These are cross-government. These are not typical regulatory guidance. This is cross-government principles. And there's a wealth of suggested actions here. The first 4 are the core principles, and they're around putting in place an enabling environment for the use of digital technologies to expand financial services. So enabling and proportionate regulatory framework, digital financial services ecosystem with sufficient adequate infrastructure, balancing innovation and risk. These are critical areas which we try to unpack and suggest actions for. Principles 5 and 6 are around responsible finance. Principle 7 is around the centrality of ID and how digital ID, unique ID, can enable access at a much more easily and lower cost. And the 8th is around the need for better monitoring, evaluation, and reporting. And supervisors tend to face a major challenge in this area, which I'll come back to through some of these cases. So we've just this year, with the German presidency of the G20, we did a review of, okay, how are countries implementing actions which are consistent with these principles? We found good examples. I mean, the India stack, the India approach, which Jason mentioned, is obviously a central one. In the case of China, how the P2P lending, crowdfunding, and what is broadly termed internet finance is now being more effectively regulated and supervised is a case we look at. How credit information has been harnessed is also a case we look at for China. We look at how can regulators and supervisors shift from the kind of the monthly Excel-based reporting and really not having the capacity to do anything with that data when they get it, to closer to automated real-time monitoring and the capacity to actually make use of that data to identify risks, trends, and be more effective in actually not just enabling, but also protecting against the risks around digital technologies. Tanzania, we looked at from a test and learn case. We look at regulatory sandboxes, but what we found interestingly, and you may well have come across this, not all regulators are comfortable with that. Many regulators say, but this looks like we're giving an advantage to some actors versus others. And so in the context of many EU regulators, they're more comfortable with the more structured test and learn approach and a bit nervous about the idea of a sandbox. But it's a continuum of approaches whereby regulators engage with, better understand, and enable innovation. The open platforms, PSD2, open banking in the UK, have already been mentioned as initiatives that regulators are taking. In the case of the UK, it's the Competition Commissioner getting involved to open up access for non-banks and for more agile, innovative providers in the financial system, which is critical. So what are we seeing in terms of use and impact? So this data is 2015. This is a fast-moving area. It's a little bit out of date, but frankly, this is some of the latest data that at a global level across more than 100 economies is available. We conduct a global payment system survey regularly. And just here's some headlines on this slide and the next one. So over 1.4 billion accounts were created in 2015. 85% of them were in China and India. Now, there are a lot of unbanked people in China and India, but not that many. That's not the same proportion as global. So that same dynamism and effectiveness in encouraging account opening and usage and the use of digital technologies, which we see in China and India, needs to be replicated across the developing world. 33%, a third, of accounts, of new transaction accounts in sub-Saharan Africa were e-money accounts, typically mobile. So that's a known story, but it's interesting to see, and that the trend on that is increasing. So in China, number of new accounts exceeded the size of the country's unbanked population. India, 2 new accounts opened for every 3 unbanked adults, which shows you that those who already have accounts are often just opening new ones. They're getting another card, for example, or another way of accessing financial services. If you look at the x-axis got mixed up, but it's 2010 to 2015, from left to right on the top graph. That's the difference between cashless transactions per capita in middle or low-income countries and high-income. That multiple is much greater than it is for accounts. The multiple has narrowed. It's now 12 as versus 19, but that's still a huge difference. So what that's saying is usage of accounts for digital uses, for cashless transactions, lags hugely outside of high-income countries. So it needs to be a major focus. Now, what we find is there's a closer link from access points, and that graph is point of sale access points and cashless transactions. The link with accounts is there, but interestingly, having access points easily available better drives or is better linked to the use of cashless transactions. Just to highlight this, we have a new guide. Governments are increasingly looking at digitizing payments, salaries, benefits, and so on. Huge potential benefits, including fiscal and transparency. But what we've made available now is a guide for actually assessing what are the costs and the benefits around transferring from cash to digital and between which mechanisms. So you're welcome to make use of this. I'll encourage your regulators to make use of it. And this is a stylized example from a couple of the initial studies we've done on this. So if you look here, we look at the different types of instruments by volume and by cost. We look at supply and demand side. And we typically find total costs for end users around 1 to 2% of GDP of using cash primarily. And then we actually calculate, okay, cash to direct debit transfer, cash to electronic credit transfer, or debit and credit cards, what percentage of GDP savings can be achieved? I think I'm getting close to my time, so I just wanted to just briefly highlight some areas that we focus on. So we work with over 50 countries, typically with ministries of finance, central banks, other regulators, but other parts of the World Bank work often with social protection payments, health payments, education payments. They'll work with digital economy, governance. So what we're trying to do across the World Bank is better leverage and coordinate the different approaches we have to encourage the use of digital transactions, digital financial services, not just through financial sector, but through that whole range of levers that we and partners such as the UN Gates Foundation have. Briefly mentioned, we're launching a new blockchain lab. This is our IT colleagues that are launching this, so we'll have use cases across the whole range of areas the bank works on, but we're exploring financial services use cases in this. We have a new initiative which is supported by the Gates Foundation called the Financial Inclusion Global Initiative. We have new work streams on digital ID, payments acceptance and usage, and we're focusing there on usage of payments by SMEs and MSMEs, so kind of merchant use, for example, business to person, person to business, and moving beyond government to person, and cybersecurity, and that's an area that we're working closely with Leon and others. So I've brought some copies of that set of case studies I mentioned, the G20 one, just a few. So if you'd like a copy, it's online. Please just ask me afterwards. Thank you.
So I'd just like to invite all the speakers up to the table. We now have around 15 minutes for questions. At this point, can I ask you to be to the point with your question? And whenever you introduce yourselves, please just state your name and your organization. We have 2 roving mics, and we'll try to take the questions in groups of 3. So we can get started now.
Just to say, some people have asked, the bathrooms for the men's are on this floor, going that way, and downstairs on the second floor for ladies. And there is free Wi-Fi if you haven't noticed. It's Columbia Open. Yes.
Cass Kalba, Kalba International. Without a doubt, the whole digital financial inclusion process, especially in developing countries, is a complex one. It's a whole pyramid. But at the bottom of the pyramid are 2 fundamental things which relate to adoption, not necessarily to people signing up for services because they think someone will send them money. But in terms of using them, they don't have a lot of money. Most of them are unemployed or only have occasional employment. And secondly, they are more sensitive to fees. So as a result, what you see is a huge gap in most of the sub-Saharan African countries, for example, between how many register for these services, have accounts, but then rarely use them. So my question is really, can we, through improvements in the process that we were talking about, also have some fundamental impact on these underlying problems? Do we need to add credit to the product so that there is some use of cash, for example? Do we need to have bundle fees rather than a fee for every small transaction that's made? Those are the kinds of things that I think have to be considered to really get the flow of usage, not just people signing up for accounts hoping someone else will send the money, to really start moving.
Okay, can we 2 more? And can we try to keep it to a very short question?
Thanks for that overture. Hi, everybody. I'm Patrick Malone. I represent a nonprofit in DC called FHI 360. So first off, thanks, everybody, for taking the time to speak with us today. And forgive my ignorance on this question, but I've been asked this question a lot, and I don't have a good answer for it. Going back to that slide, I think, Jason, that you brought up about, I think the McKinsey report, the contribution to GDP growth, I think it was 3.7 trillion. We have a lot of projects in Liberia and other countries that deal with GDP payments. But I was wondering specifically if you knew where from, if I think about the sort of calculation of GDP, where specifically are those gains being drawn from? And if you had any numbers around those specifics, that would be helpful too. Thanks.
And one more?
Hi, Greg Welliver from PayPal. Going back to the topic of introducing new products into these underdeveloped markets, how big of an obstacle has education of consumers been in adoption? So just because these digital financial products are becoming available, do people kind of understand the value prop, and is that kind of slowing down adoption?
Okay, so we have 3 questions. The first one is, how do you get beyond adoption to usage? The second one is specifically to Jason on GDP payments and specifically where the numbers come from, where the gains are from. And the last one is on financial education and whether or not that acts as a barrier. Maybe we can start off with Jason taking the question on GDP payments. And if I see hands, please tell me who wants to take the other two questions.
Sure. So I'm quite happy to share the full report with you, and actually it includes the methodology around where the 3.7 trillion comes from. There are probably two parts to it that sound like your question. First of all, if you include people in the formal financial sector and they put their deposits in banks and that becomes available for credit, then you have more availability of credit for investing in small businesses and so forth, which create jobs. And so it becomes actually a virtuous cycle of more money in the system, more money for credit, more money for business expansion, and in fact, even more opportunities for governments to invest in infrastructure like a power project, because they have ways to collect fees per use. The second part of your question might have been specifically around the leakage in government person payments or person-to-government payments. And a lot of that comes from, for example, ghost accounts that governments pay out to somebody that doesn't exist because actually a fraudster is waiting to collect that money in the ghost account, or coming from government payments to somebody who actually receives the money but actually doesn't receive it in full because somebody takes a cut along the way. That accrues then to the consumer. On the reverse side, the same type of thing happens where people take their cut, or subsidies aren't really reaching consumers exactly. So I can share both the original report and then the second report, which actually dives deeper into government leakage, will be released, should be shortly, but I can give you the draft even for now. It's close to done.
Okay, who wants to take adoption versus usage? Doug.
Sure, thanks. Maybe if I can tie that in a little bit with the consumer education one as well. There's some crossovers. Okay, thanks. So one of the barriers to this is when a particular government payment is shifted into an account or a card. I think of multiple examples worldwide. It can be shifted into a card which is really not usable for anything else. It's not a functional account. Or if it is a functional account, people don't know it is. They just know that's how they get this particular benefit or wage, and that's what they do. They go to the ATM, the point of sale, they withdraw it in cash, done. No further interaction with that account or the financial system. So some of that is in the design of the product. Some of that is in how government has procured that. Have they procured it in a way which gives people choice between providers? And some of it is around messaging and awareness. Are people aware of it? Has it been communicated? And consumer education, the link there is interesting because typically, and we're doing work around what works in financial capability and education, typically governments do financial awareness campaigns. Central banks love them. We know central banks really like doing financial awareness campaigns. And the cost effectiveness or just straight effectiveness of these is very unclear. And what is much more clear is Juntos Finanzas and other more fintech type approaches that are using data on consumer needs, understanding behaviors, and then using tailored messaging, including through mobile phones, and behavioral nudges. That has very direct links with changing behaviors. What has much less direct links is financial awareness campaigns. So that's an area we're trying to get better quality guidance and tools out there. And maybe just briefly on usage as well. We're doing a paper on InsurTech. InsurTech is, whether you like the term or not, the point is using data and using mobile money convenience and transaction accounts to provide bite-sized, timely, immediately available, affordable insurance products, and basically rethinking how insurance is done. And that's one of the ways that transaction accounts are going to get more widely used. Thanks.
Just to follow on that point, I think fundamentally the question was asked about adoption versus usage, and effectively it all comes down to cash in, right? So you need to create a catalyst or a stimulus to have people trust the system and put cash in the system, or else it fundamentally flounders. And in doing so, I think you need to look at both the social, the economic, and the cultural indicators within those different regions, which are going to be wildly different. We had the pleasure many, many years ago working on M-Pesa, and it was an extraordinarily unique set of circumstances where I won't go into, which made that uniquely successful at the time and continues to be uniquely successful. But for example, you can look at some of the cultural innuendos in places like South America or the Caribbean, where there's a startup that's doing a mobile money scheme that's largely oriented around lottery, because lottery is embedded into that environment, and it's gained adoption using the lottery as sort of the Trojan horse to drive education, drive usage. In South America, there's a transit operator where they have 8 million transit accounts, and they're trying to layer mobile financial services on top of that because they have an install base, and transit is a card or an application that they use every day. So I think there's not a one-size-fits-all, and I think you need to sort of look at each geography, look at the social, cultural, behavioral innuendos, and the infrastructure, whether it's an agent network, whether it's connectivity, a variety of different technical implications, to come up with the right solution. So I don't think there's one stock answer that fits what's the way to get usage out of a mobile money system.
Hart, do you want to come in, or do we, oh, sorry, Sean, do you want to come in, or do we?
I think we got it.
We got it, okay, so 3 more questions?
So thanks for referring about India Stack. So I am a regulatory technology entrepreneur from India. So proud to hear India Stack here. So how are you seeing the developed markets, like even US, to use SSN or any other, the people citizen identifier information for this, any of these distribution mechanisms? Trying to understand mostly on the privacy aspect of it.
Hi, Pam Dixon, World Privacy Forum. So I participated in the G20 this year, the Digital Ministerial, and one of the core questions that came up was the issue of trust. So I would be interested in your comments on trust frameworks, including trust frameworks around data protection as well as liability reduction. And beyond that, if you have any comments on alternative form of credit, and how that might fit into a variety of trust frameworks. Thank you.
Thank you. Anida Lichai from UNICEF. This question is in particular to Mr. Pierce from World Bank, but to anybody else who'd like to answer. Do you see a current application of blockchain technology in social protection systems currently? Thank you.
Okay, so we'll take these 3. Please correct me if I'm wrong, but I thought your question was the privacy challenges providing comparison between developing countries and the US. The other question that we had was on trust frameworks and how that relates to data protection. And the final one was DLT for Doug. So Doug, do you want to start with the question on DLT, and then we'll divide up the other 2?
Sure. That's one of the reasons we're setting up this lab approach. Is what we find is there's, on paper, there's compelling use cases for DLT, including for social protection, GDP payments, humanitarian payments. In practice, there's not much tested. So let's actually just test that in the field. So there's some interesting uses around ID. Obviously, I think in the refugee context, how do we overcome that? And the technical side of overcoming that and ensuring that we have, IDs linked to one person is probably easier to overcome than meeting the FAT of your CDD requirements around that. The two we haven't quite made that bridge yet. In terms of use of payments, there's UK and other countries which are using blockchain to actually track how the payments are used or to check how they're used. If there's fraud is being looked at in the case of, I guess, following the Ebola-related payments, where we and others got involved to help improve the transparency and avoid leakages in that context. I think we'd like to initiate some pilots and some testing in humanitarian cases of how to use blockchain. And the other is compliance. compliance and can you embed compliance data in transactions so that you don't have to be doing CDD each time. So there's a potential competition benefit and also cost benefit. And I'm sure you can think of others. But I think the UN, UNICEF have set up, there's a whole range of initiatives. And I think the faster we can be working with partners to test these and get proven use cases, the better. Thank you.
So we have only like 2 minutes left, so maybe we can bring Sean in on one of these, and maybe Harder.
How about the trust one?
Okay,
All right.
go ahead.
The
Yeah.
trust framework from your question back here. What's interesting about the work we did with the task force is of those 36 criteria I talked about for this new payment system, 11 of them were around safety and security. A great deal of focus on those issues of trust, authentication, errors, overdrafts, revocability of payments, fraud data sharing, credit push payments versus debit pool, because there's different fraud frameworks for both of those. Credit push being a little more secure and less fraud available, if you will. So I think the trust framework that you're speaking of is paramount in everybody's minds around what we would do with a new system. And we actually have set up a secure payments task force in addition to this faster task force that I'm leading. I have a colleague, Todd Adlin, who's leading 175 people